guys, right now, my dividend growth portfolio is trading at $81,758.72. And today we are going to get into what I hold in this portfolio in order to generate me, nearly $4,000 annually in passive income, guys. Let's get into it. This is an all-time high for my portfolio. That's exciting. I guess last week we had a few closes right above that 82K mark, and now we're, right below it. So virtually, we'll call this an all-time high. That's always exciting, guys. Let's get into it. Okay, so, from a bird's eye view, this portfolio generates me $3,636.59 in estimated income. That breaks down to a monthly average just over 300 at 303 and change. Per month in October, I'm estimated to earn $323. November, I will earn $107. And then in December, that 3, 6, 9, 12 being my highest paid months, I'll be earning $479.06, guys. Okay, so we will get into what positions I have in this portfolio. Let's go ahead and check it out and sort by market value. Coming in at number 1, we have Altria. As you guys have seen, this has been my number 1 now for, I believe, 2 to 3 updates. The reason why Altria is my number 1 is because of the capital gains and growth I've seen in this one. Okay, I would say it's my best example of patience paying off in this dividend growth investing game. So I have 250 shares long. I've been building this position out, I would say for about 4-ish years. I began buying, in the 40s, average down while we saw Altria consolidate in kind of this wedge pattern. And once I saw Altria break out of this wedge and begin an uptrend, I stopped buying. Okay, I had my 250 share position built out. Now I am enjoying capital gains, I should say, as well as, a good amount of dividend income. I will be interested in adding to Altria again if it comes back down, I guess towards the support line I've got drawn here. So, if we see it kind of come under 49, if we see it in the mid to high 40s, I would be interested in taking this one to 300 shares. Until that happens, which I wouldn't anticipate would be until, next year or the following, I'm going to keep my 250 share position. No trims coming anytime soon. And I'm going to enjoy, my estimated $1,060 in income from this position. Okay. Again, guys, that one's at 16.5K market value. Next up, we have Hershey. I have 72 shares at a market value of $13,255.92. We will go ahead and look at this one. So again, this is a relatively newer position, especially compared to Altria and a few others in my portfolio. Looking back, as you guys can see, I started adding this one in mid to late 24 as I saw it in this consolidation period. Okay. Now, oh my gosh, what are we doing here? Now, my hope, I don't want to say my hope, I'll say my thoughts were at the time that Hershey would consolidate and reverse, and this would play out as kind of a dip buy. That didn't happen. It continued lower, and now it's consolidating again. That's okay. As you can see, I've continued building out my position in Hershey. I have an average price on it at 183. It's trading at 184, so I'm virtually break even on it. I would like to take it to, roughly 100-ish shares here in the next 3 to 6 month period, as long as it kind of stays in this shaded area I've got here. And then I think I will lock in, an attractive cost basis, and I will experience some great long-term capital gains as well as dividend growth. Okay, so that's kind of where I'm at on Hershey. Um, Again, it's not my top priority right now, but it's definitely one I'm interested in adding to. Okay, so that's 13,255 market value, and it pays me roughly $400 in estimated annual income. Okay, so we've seen Altria. I'm not interested in adding to it until it gets back below that $50 price point. And then we've seen Hershey. I am interested in adding to it, maybe taking it to 100 shares, but we will have to wait and see on these other guys. Next up, we have Realty Income Corp. Guys, this is my only REIT that I hold in the portfolio, and it is my only direct exposure, okay, to the real estate industry, right? Obviously, Starbucks, in a sense, is a real estate play, okay? But my only direct exposure would be Realty Income, okay? Market value on this one is $13,000, and it pays me roughly $700 in estimated income. Guys, this is a monthly payer. This is one that I'm looking to add to, but I'm not in a rush. My average price on it is 65. It's trading at 60. So I do have a small capital loss unrealized right now of $991. From a technical standpoint, a similar pattern we've seen to Altria. However, my timing and my patience was not as good on this one. We see kind of a descending wedge, and then we see it kind of break out of that pattern. I say break out because this is a pretty slow mover, and it's not going to make the same type of explosive moves as a lot of other large cap stocks could make. But we see it break out of this descending wedge and continue to consolidate. I do think now would be a good time for me to continue building this one. If you're an investor at home, I would encourage you to further look into this one. Long term, I'm just going to keep an eye on it. I'm pretty comfortable with my exposure to it. It's my third largest position, and I have other stocks that I'm looking to build, first and foremost, I guess. Moving on. Well, that one pays me $695 in estimated income. Next up, guys, we've got Pfizer coming in at 486 shares at a market value of $11,591 and change. That one pays me an estimated income of $836. Let's go ahead and check this one out. Here we are, guys. As I just briefly touched on, I have been building this one out. I want to take it to 500 shares, but I would like to see this one start reversing, okay? If it stays in kind of this weak downtrend / consolidation that it's been in, it's going to be hard for me not to continue buying it. Okay, I would say if Pfizer, what am I doing here? Pre-buffering. Hold on, what's going on? Nuts. Okay, sorry about that. I would say the only reason I would stop buying Pfizer at these levels would be if I move it up to a point where I'm worried and concerned about concentration risk. Okay? I really, really like the valuation of Pfizer, as I keep saying time and time again. So, definitely before the end of this year, I'd like to get this one to 500 plus, and we're going to do just that. But, we'll have to stay tuned. I'd say definitely out of the positions I currently hold, Pfizer is the one where I'm immediately putting capital. Okay, I talk about this all the time, guys. I don't reinvest dividends into their respective payers. Every dollar I get, whether it's net new capital invested or it's dividend income, I always put towards the one or two stocks that I feel is the most opportunistic. And for me right now, that's Pfizer. Okay. I love the valuation. I love the moat. I love the diversification. and we're going to continue building it out. Okay, I know there are some risk, as there are with any company, but you know, let's not get carried away and make this a whole Pfizer video. Next up, guys, we have PepsiCo, ticker PEP. I've got $8,410, paying me $341 in annual estimated income. And, you know, for this one I've been building out kind of in this recent downtrend it's been in, you know, with its high coming in mid 23 at 196. We've seen it make lower highs, lower lows. Guys, it's a textbook downtrend. However, I have been expecting this one to bottom and begin to reverse off, as you can see here, this 2020 high. Okay, so that's kind of what I've got charted out here. I see what could kind of be interpreted as a rough inverse head and shoulders. Okay, so I will be continuing to buy this one and will be continuing to add to Pepsi until it breaks kind of this neckline. Okay, so until it kind of breaks the 160 mark, I would be interested in building this one out further. Okay, we will have to wait and see how it plays out. You know, maybe I'm wrong and we see it kind of fade out and make a lower low through the rest of the year. That's not my expectation, though. My expectation is that it consolidates and kind of drifts towards this 160 mark, and then I'll be done buying, okay? So I talked about here being opportunistic. I'd say the two I'm most interested in building right now are Pfizer and Pepsi. All right, so again, Pepsi, 60 shares paying me $341 annual income. Okay, this is not a significant number. I want to build this one higher and higher. Next up, we've got Apple. You know, I touched on it earlier, but this has been one I've trimmed to free up a little bit of capital to reinvest into Pfizer. Okay, so I'm clearly, obviously not buying tech right now. You know, it doesn't take a genius to look at a chart or look at the news and tell you that the NASDAQ is overextended and due for somewhat of a correction. If you guys have been with the channel, you know, I guess the moving averages, the indicators I like to use on a long-term basis, I keep it very simple. I keep it very straightforward. It's the 50-week moving average and the 200-week moving average. These are the indicators I use as a long-term investor or even as a long-term position trader. You can call it what you want. I typically look for companies to be extended or below the 200-week moving average. I use that as kind of my valuation indicator. And then I use the 50-week moving average as kind of my momentum or direction indicator. Okay, so with the NASDAQ being very extended from this green line, that's the 200-week, and then this blue line is the 50-week, with its momentum pointing straight up to the sky, I'm obviously not touching, all right, kind of the names that are carrying this explosive growth in the NASDAQ, the Apples, the Microsoft, Nvidias, etc., etc. Okay, let's move on. After Apple, we've got, Apple pays me, 26 in income. Okay, so this is a dividend growth play. It's not a current income play. But while this is a pretty, measly number for estimated income, Apple has been good to me in the sense that I have been able to opportunistically trim shares of it to reinvest into some of the value names I've wanted. Okay, and I know for those of you that have been on this journey, you've seen me take off. Every quarter, you've seen me take off, a few more shares of Apple. Moving on, we've got Starbucks at 70 shares. That's a market value of $5,994.80. That pays me an estimated income of $170. Starbucks, I'm not necessarily interested in adding right now. It's kind of been one that's been on the back burner for me. Reason being is not technicals and it's not fundamentals. Um, I would say it's more so on the side of my own personal risk tolerance. You guys know I talk about companies having a moat. I do believe Starbucks has a wide economic moat. It has that rating of being a wide moat company. However, for my own personal risk tolerance, I typically like to look at companies that have a wider moat than Starbucks. And I don't see Starbucks being a company that's recession resistant. Okay? And for me, for my own personal definition of, an economic moat, I like to include a company's resistance to recession or recession proofing. Okay. Obviously, Altria, we've been talking about it. It's an example of recession proof. Okay. If the going gets tough, the tough get going. That's what they say. Altria is recession proof because people who smoke cigarettes are not going to quit if the economy is in the toilet. Okay? People who buy frappes and caramel lattes every day, okay, maybe if the economy's in the toilet, they're going to say, okay, I'm going to use my Keurig that I have in my pantry that my grandma got me for Christmas in 2019, and I made 1 cup of coffee with it, and now I never use it anymore. Okay, I'm going to break that bad boy back out. Okay, Starbucks is not recession proof to the same tune as some of these other guys. Okay, even like Hershey. All right, people are addicted to chocolate. It's an addiction. All right, overpriced macchiatos, that's more of a status symbol. Moving on. Next up, that Starbucks pays me, $170 annually. Next up, we got Microsoft MSFT, $51.46, and it pays me $36 and change. Same boat on Microsoft as I am on Apple. Okay, so I'm not going to sit here and over explain. But, we've seen Apple make, a double top pattern at this 260 level. Whereas Microsoft, it hasn't made a double top. It's actually exploded to an all-time high. However, the momentum, from a bird's eye view, the momentum is the same. I'm not touching either. I see them both as very overextended, from their 200 week. Okay, so again, Microsoft only pays me $36 annually. Lastly, I've got T. Rowe Price. I got 15 shares of it at $15.52, and it's paying me $76 annually. Guys, I'm not interested right now in adding to T. Rowe Price. Just because, again, it kind of goes back to the own personal risk tolerance thing. We'll take Starbucks as another example. I'm happy with Starbucks being a low to medium sized position in my portfolio. Kind of, not a cornerstone of my portfolio. I don't have that personal risk tolerance for Starbucks. For T. Rowe, I think I even have a lower risk tolerance, just because a lot of their funds, a lot of what they do, and the performance of these funds is tied to the broader market. So, it's almost at a point where the broader market determines the fundamentals of T. Rowe. Even with great management, even with great fund managers, it's still kind of tough, okay? So with that being said, the financial space is not a space that I usually like to use as a cornerstone of my portfolio. As you guys can see, I like consumer staples. I like pharmaceuticals. I would consider Pepsi consumer staples. Hershey, I consider that a consumer staple. Maybe it's discretionary, but that's up for debate. Anyway, the financials is not kind of not a cornerstone play for me, guys. Okay, so with all that being said, thank you guys so much for joining me in today's review. Again, I'm Cashflow Cart. I try to post one video a month, keeping you guys up to date on my portfolio, at least one video a month. We go over, my trades, my big moves, etc. If you're not subscribed already, please do that. You made it this far. Thank you guys. Everyone have a great rest of your week, and let's build.